side. But let's shift focus away from the equities and talk about the personal finance space. Harshvardhan Roongta of Roongta Securities joins in to talk about that. Harshvardhan, hi. Thanks for joining us on the show. The markets are really volatile right now, and a lot of investors who call in are scared to invest in equities, especially after the carnage that we've seen in the mid-cap stocks and the big blow-ups without any, intimation of sorts. How should one really design his or her portfolio, you think, so at least the basic principle that you invest in the market gets protected, and at the same time he can perhaps benefit from investing in equities?
Well, Sonia, you're right. I mean, if you see any of the recommendations that financial planners make, we keep using the words diversification and asset allocation. So the main idea is that irrespective of however good a particular investment looks at any given point in time, you do not put all your money into one avenue itself. Let me explain the benefits of asset allocation with an example to you. Take a case of an investor who has about 1 lakh to invest for a 5-year tenure, and he's given a very clear mandate that he doesn't mind low returns. Okay, he's a safe investor by nature. He says, I do not want higher returns, but I want my capital protected. So the first obvious thing that he can think of is that he puts the entire 1 lakh into a fixed deposit with a bank, earns say about 9% returns on it. So the value after 5 years, if you look at it, would be about 1,53,000 rupees. Now option 2, we look at asset allocation, and then the advantages of asset allocation. We keep in mind that the mandate is that he needs his capital protected. So we divide the 1 lakh as 70% into debt. So 70,000 goes into fixed deposits. 30,000 goes into in a basket of well-managed stocks. So we put it into, say, equity mutual funds. 30,000 goes into that. Now, if you look at 5 years from now, the 70,000 that has been invested at 9% becomes about 1,07,700 rupees. The 30,000 rupees which is invested into equities, we take 2 or 3 scenarios. The first is if it gives 15% return, which we expect from equities to give over longer periods. So the value of 30,000 becomes 60,000 rupees. So if we combine a 1,07,000 which the FD has generated and a 60,000 rupees which equities has generated, the portfolio is about a 1,68,000 rupees. Now this is much higher than what an only FD portfolio gives, which is about 1,53,000. So the weighted average of a portfolio which is 70% equity debt and 30% equity comes to about 10.93%, which is about 200 basis points higher than what a fixed deposit would give. Now, an interesting observation in this asset allocation is that the 70,000 rupees has grown to become 1,07,000 rupees. Now, assuming and hypothetically assuming that equities become nil completely, you lose all the money that you've put into equities, which is unlikely to happen if you've got a basket of good stocks. But however, if that becomes completely zero, his 1 lakh is still intact because the value of fixed deposits is 1,07,000 rupees. Now, so this is the power of this is the benefits of asset allocation. Now, what percentages do you allocate are different. Let's look at another scenario, the equity part of it. See, if equities go nowhere, 30,000 rupees remains at 30,000 rupees. The portfolio value at the end of 5 years would be 1,07,000 in FDs and 30,000 of equities, would still give you a return of 6.6%. Assuming that the markets have done very badly, you've been unfortunate with your equity allocations, the fund has become half of its value. So 30,000 invested after 5 years is giving you 15,000 rupees. The portfolio still generates a return of 4.17%. So the idea is that if you invest very conventionally, very conservatively, you cannot even beat inflation. The weighted average return is actually negative in a high inflation scenario. So so I would suggest that all investors, however risk averse they are, go in for asset allocation, get that extra additional returns, which at least helps you beat inflation over a longer period of time. So for a safe investor as well, if you do an asset allocation with a 70-30 portfolio with a 5-year horizon, you can get your capital protected.
Fair enough. Thanks a lot for that. But we have a lot of viewers with their questions, specific questions. Harsh, we'll take a break and we are back in a minute. Welcome back. Markets are just moving into flat terrain now. We may see a bit of green in a few minutes. It could be propelled by the European markets showing a shade of green, at least in the futures rates that we just showed you. The CAC and the DAX look like they will open in the green in the next 1 hour, and that could be having some kind of a positive impact on the Indian markets, but we are talking very, very narrow ranges at this point in time. So let's shift to personal finance, where we just heard Harsh telling us how you can protect your capital by going 70% or putting 70% of your savings into FD and another 30% in equities for a 5-year period. We have a caller, Saurabh Sahu, joins us from Pune. Saurabh, go ahead. What is your question?
Yeah, hi, this is Saurabh calling from Pune. Actually, I have a query regarding the mutual fund investment. I would like to invest in mutual fund for a long-term duration, around 15 years. So just want to know what are the good mutual funds available currently in the market. I just want to invest in equity as well as in the other funds.
What would be your annual investment, you think, in terms of an amount?
Around 5,000 per month.
All right. Well, that's a fair question, Harsh. I might just add my own one question into it. Since he's talking about a 15-year period, could you also advise him and us on what points you should keep re-looking at your investments in mutual funds? When should you take away some money, if at all? When should you churn the portfolio, if at all?
Lata, answering Saurabh's question first, he's looking at 15 years tenure. He wants to invest 5,000 rupees a month. Now, I have been a strong advocate of index funds for a long time now. I'll give you a couple of reasons. Index, if you analyze the data since inception, the Sensex has given about a 17% returns. Now, the Sensex comprises of 30 stocks which are large caps and which have a free market float. Besides, in an index fund, it's one of the cheapest modes of owning equities in present terms. The fund management charges are the lowest when you compare it to actively managed funds. Now, on the third part is that over 5 years and above period, we've seen that less than 50% of the fund managers have been able to beat the benchmark Sensex. So my idea is that how do you choose that one particular fund manager who is going to beat the Sensex? Now, if you have to go through all this, now I'm combining this answer with your question as well. If you have to be in equity mutual funds for a long time, and if you've chosen an actively managed fund, you have to regularly monitor the performance of the fund. You have to see whether it is deviating from its objectives and all that. But nevertheless,
Harsh, I'm really sorry, I'll have to cut you off because there is a major interview that the market is watching out for. Shireen Bhan is speaking to the Aviation Minister Ajit Singh.